Welcome back to the Options Academy. In this presentation, we'll discuss another naked option strategy called Straddles. As always, to maximize your learning experience, you can refer to our written article which matches this presentation. What is a straddle? In more ways than one. The straddle is the natural next step, which would follow selling naked options and strangles. The elemental aspect to remember when considering the straddle is a very important rule we have mentioned in other articles. What you collect always remains yours. This rule holds true for a winning trade or a losing one. In the case of a winning trade, the entire premium collected, or a part of it, might represent the profits. In the case of a losing trade, whatever premium was collected at the inception of the trade would offset some or all, in some cases, of the loss. Either way, whatever premium you collect always remains yours. The straddle strategy entails selling two options, a call option and a put option, on the same strike price. For example, selling the 50 call option and the 50 put option will create a straddle. Selling a call option and a put option at different strike prices will create the strangle, which we spoke about earlier. Therefore, the defining aspect of the straddle is that the two options, the call and the put, are sold on the same strike price. The strike price may be at the money or a combination of in the money and out of the money options, but in any event, the structure always consists of a call option and a put option that are sold on the same strike price. You can find several illustrations of the different types of straddles in our written article about straddles on our website. Selling a call and a put at the same strike price usually results in large amounts of credit, since options which trade at the market current levels or in the money options are expensive. The main feature then of the straddle is the large amount of a premium a trader collects when applying the strategy. In fact, with the exception of some deep in the money spreads, there is no other option selling strategy with the potential for collecting more premiums for one single construction than the straddle. The underlying logic being that the strategy is similar to that of the strangle, namely that any underlying market tends to trade in a range-bound fashion more often than not. The seller of the straddle aims to collect enough credit to cover a potential bullish or bearish move that may occur within a very specific time frame, which is the time span from the inception of the trade to the option's expiration date. Let's take a look at the Standard & Poor's 500 stock index and draw an example from its pages. As you may already know, if you watched or read our previous presentations, the multiplier for the S&P 500 futures contract and options is $250 for every point. That means that a move from 1,000 to 1,001 is worth $250, and a move from 1,000 to 1,010 reflects $2,500. It also means that an options marked with 5 points of premium is valued at $1,250, and an option marked with 10 points is valued at $2,500. For our example, assume that the Standard & Poor's S&P 500 is trading around the 1,000 level, and that we are constructing an at-the-money straddle. While volatility levels will inevitably have an effect on the amount of premium we collect at the time of writing this paper, which I am now presenting to you, selling an at-the-money straddle 43 days before expiration fetched a premium of approximately 64 points or $16,000. Let's take a quick lesson in practical trading. Now, it's important to note that the scenario of holding the straddle until expiration is very highly unlikely, and this is because of two practical reasons. In practical trading, you might not want to or might not be able to hold the options to the moment they expire. Practically speaking, if the market trades around the 1,000 level several days prior to expiration, the trade will show very handsome profits. The straddle will probably lose 70% or more of its value. At that point, most traders would rather take the profit and not risk a sudden large move in the last few days of the trade that will take away their profit. Another practical trading fact is this: the options will expire completely valueless only after the closing of expiration day. In the unlikely scenario in which the market expires exactly at the level of the straddle, in our case the 1,000 level, you will have to wait until the closing bell to find out the exact spot in which the market expired. If you do so, if you wait until the closing bell and the market expires just below or just above the 1,000 level, you will be assigned a position in the underlying market. In fact, even if the market expires exactly at the 1,000 level, you will most likely be assigned either a long position or a short position in the underlying market. I want to qualify this statement by saying that on quarterly months there are no assignments and the S&P 500 is cash settled. If you are assigned, you will expose yourself to a potential loss should the next day's session open against your position. For example, if you were assigned a long position in the market and the market opened down, Therefore, the straddle should always be closed prior to expiration. Back to our trade. So, we sold the 1,000 straddle on the S&P 500 and collected $16,000 or 64 points. The collection of 64 points means that at expiration the market may be 64 points away from the point of establishment before loss is registered. It also allows for the market to trade in a range of 128 points in a 43-day period, 64 points above the market level in which the straddle was sold and 64 points below the market level in which the straddle was sold. This is a nice wide margin in most market conditions. Expiration anywhere between these goalposts will represent profit. Let's take a pick at a few scenarios, and here again you might find it useful to refer to our written article. Scenario 1. At expiration the market moved 50 points down on a bearish trend. A. The call option expires out of the money and worthless. B. The put option expires in the money with an intrinsic value of 50 points. C. Total value of the straddle at expiration is 50 points. 0 plus 50 equals 50. Total credit collected at inception, 64 points. Total profit on the trade, 14 points. 64 minus 50 equals 14. Total profit in dollars, $3,500. 14 times $250 equals $3,500. Scenario 2. At expiration, the market moved 20 points up on a mild bullish trend. A. The put option expires out of the money and worthless. B. The call option expires in the money with an intrinsic value of 20 points. C. Total value of the straddle at expiration is 20 points. 0 plus 20 equals 20. D. Total credit collected at inception, 64 points. E. Total profit on the trade, 44 points. 64 minus 20 equals 44. F. Total profits in dollars, $11,000. 44 times $250 equals $11,000. This might be the moment to remind and stress that the straddle, similar to its close relative, the strangle, is not a spread but rather a naked option strategy, and as such carries unlimited risk. Let's take one scenario. Scenario 3. At expiration, the market moved 100 points on a strong bearish trend. A. The call option expires out of the money and worthless. B. The put option expires in the money with an intrinsic value of 100 points. C. Total value of the straddle at expiration is 100 points. 0 plus 100 equals 100. D. Total credit collected at inception, 64 points. E. Total loss on the trade, 36. 100 minus 64 equals 36. F. Total loss in dollars, $9,000. 36 times 250 equals 9,000. Though this last example was concerned with a bearish move, an opposite bullish move would garner the same results. Beware then, and be aware of the risk which is inherited in the straddle, as in with any naked option selling strategy. Let's take a look at a directional straddle. The straddle is to a great degree a non-directional strategy when one is sold at the money. Some traders, however, prefer using the strategy while speculating on specific market directions. To do so, the trader determines the direction he or she thinks the market will trend, and then establish a straddle position which is in part far out of the money and in part deep in the money options. Here is how it works. Let's assume that the S&P is trading at the 1,000 level. Since the market rarely rests, it is virtually impossible to create a numeral example which is timeless and relevant to the time you watch this video or read this paper. Therefore, if the S&P 500 is trading at a drastically different level at the present time, simply move your prism and look at a straddle which is 50 points in the money, such as this example. In order to create a directional straddle 50 points in the money with a bullish outlook, we would sell the straddle at the 1050 strike piece. In detail, we will sell the 1050 put option and the 1050 call option. The put will fetch a great premium since it's deep in the money. It's 50 points in the money to be exact. To illustrate, at the time of writing this paper, a put option, which was trading 50 points in the money and within 55 days to expiration, sold for a hefty premium of nearly 70 points or $17,500. To complete this in the money straddle, we would sell the 1050 call option. The call option with identical distance from the money and with the same expiration date settled at the time of writing for approximately 13 points or $32.50. Selling both options then, a trader would collect premiums totaling $20,750, nothing to sneeze at. Should the trader be accurate and the market scale up to finally expire at the level of the straddle, the trade will show windfall profits. As the market trends up prior to expiration, while the call option will gain value and therefore represent a loss, the in-the-money put option will deteriorate and in a much more rapid pace and therefore representing a profit. This is because the delta on that put option is much higher than the delta on the out-of-the-money call. And you can refer to our delta article and presentation to learn more about delta. Eventually, if the market fails to breach the 1050 mark, the 1050 call will start to lose its value as well, until it fades away and joins the majority of out-of-the-money options that expired before it. Even if the market rises less than expected or remains unchanged, which is possible but not probable, or even if the market rises more than the trader predicted, the trade might very well yield nice gains. Let's take a look at the break-even points of the trade. In order to calculate the exact break-even points, all you need to have is the amount of premium you collect and the strike price you sold. In this case, 83 points of premium were collected for the sale of the 1050 straddle. Break even above the market. A. Level the straddle was sold, 1050. B. Premium collected, 83 points. C. Break even point, 1050 plus 83 equals 1133. Break even below the market. A. Level of the straddle was sold, 1050. B. Premium collected, 83 points. C. Break even point, 1050 minus 83 equals 967. In this specific scenario, expiration between these markets, the 1133 on the upside and the 967 on the downside, would translate to profit. The range between the 1133 call and the 967 puts it 166 points. With such a range, even in a volatile environment, expecting this trade to win is reasonable. Let's talk a bit about straddles and volatility. There are two opposing opinions relating to the best market conditions in which to apply the straddle, low volatility or high volatility. We prefer to take the position that both have their merits and challenges. Taking this stance makes it easier to be pragmatic to the market, taking advantage when the right circumstances appear and avoiding unnecessary risk when the situation deems caution. In times of high volatility, premiums are drastically overvalued and inflated, and therefore the premiums collected are high. Since a central feature of the strategy is the amount of premium a trader collects, many speculations are drawn to trade in high volatility environments. If you too subscribe to this notion, it's important to remember that high volatility means wide market movements, more extensive than in normal conditions. These wide movements increase the possibility that the market will expire beyond the desired range. During times of low volatility, the market tends to move in a more range-bound fashion, and therefore the probability of the straddle expiring worthless is higher. Low volatility, however, translates into lower premiums, which shrinks potential profits, as well as the range in which the market is allowed to trade. The straddle, then, has its advantages and shortcomings in both high volatility and low volatility conditions. The underlying principle in both states is the amount of premium a trader is able to collect. No matter when you sell a straddle, we recommend always keeping in mind that the straddle is a naked option strategy and always carries unlimited risk. Here is to your success. And remember, there is a risk of loss in trading futures options. Remember that past performance is not necessarily indicative of future results. And remember that only risk capital should be used. I hope to see you again soon.